Welcome to the Capital Focus Luncheon, the first one for 2017. It's great to see you all here. The main purpose of these sessions is to give you the opportunity to hear from the fund managers that manage a lot of your wealth.
As Michael mentioned, my name's Mark Cormack. I'm a director with an ASX-listed business called Pinnacle Investment. We're actually, as I mentioned, listed on the stock exchange. We're a fund management group that has a number of different sub-branded fund managers underneath us, of which today we're very proud to be discussing global equities with the Antipodes Partners Group. The ability to look through a lot of the noise is one of the key differentiating factors that we have at Antipodes in terms of our previous track record and how we're looking at markets. And what we're doing is that we're looking for opportunities where you guys otherwise wouldn't be looking. What we do is we manage a portfolio of stocks, and what we do is we invest long. And most people here would know what investing long is. It means you're buying a share and hoping it goes up. We also can go short, which means you're investing and hoping a share goes down, so you're making money when a share goes down. And then we're also actively using currency, and we'll go into that in a little bit more detail in a moment. And what our ultimate goal is to give you global equity exposure at lower levels of volatility. So joining me today is Andrew Baud. Andrew worked with Jacob at Antipodes, and Andrew was lucky enough to head up the US office of Platinum with Antipodes, with Platinum, and came back to join Jacob here in Australia to set up Antipodes. And Andrew is the Deputy Portfolio Manager sitting under Jacob Mitchell.
At Antipodes, I find that people mostly get caught up talking about returns or performance. But for us, it's actually all about risk. And this is one of our internal sayings, that if you manage risk well, returns will actually take care of themselves. Next, you need to consider multiple ways of winning. Now, multiple ways of winning for us is that you need at least to come up with 4, 5, 6 ways that you think this business is going to perform well in the future. You don't want to rely on just 1 or 2 points, because to us, that's 1 or 2 points of failure.
The stock that really typifies the way we invest over the last 12 months has been a business called Samsung. Has everyone heard of Samsung? So, why would you invest in Samsung? We're looking at a business that's very cheap. Secondly, this business is a global business. Thirdly, if I look at my iPhone, my iPad, all the memory that goes into these devices is made by Samsung. So we've looked at this business and we've said cheap on valuation, and it has those multiple ways it wins through a global product. So what the quantitative analysis does is just really highlights areas where we can look for businesses where we can pick those stocks that we think are cheap on valuation, they're going to go up and go long, or expensive stocks where we think they're expensive relative to history and we think we can make money when they fall.
Hyundai Motors is now our largest position in our portfolio, so this represents about 4.5%. They have the least amount of defects for those cars. They're just good, reliable cars. So not only do we get good, reliable cars, Hyundai is also going into a new product cycle with a number of new models, which should help attract attention and sell more cars and make more money. But on top of that, the actual business itself is super cheap relative to what you could pay for other auto manufacturers around the world. So we put all that together. It does give us that margin of safety. We can see multiple ways of winning. Now, that's why it's a key part of our portfolio, or actually the largest position now in our portfolio.
We're selectively looking at some European banks in the portfolio. And I'll give you a really good example of one of the holdings that we've had in the portfolio over the last 12 months is a group called ING. Very cheap. It actually pays a 6.5% yield. Certainly meets our requirements from valuation, multiple ways of winning, and it is in the portfolio. So what we're doing at Antipodes is looking for the extremes in currency. Timing currency on a very short-term basis is very hard to do. So what we're looking for is currencies that are very overvalued and currencies that are very undervalued. What happened with the Norwegian currency? It got sold down, the oil price went down. We look at Norway and we say stable economy, low unemployment, an economy that's got house price reflation, an economy that's actually running inflation at 4%. So our view is that potentially it could be one of the very first economies to put interest rates up. What does that mean? The currency should follow. So we're looking for those types of opportunities to generate returns in the portfolio. We're going to look through the noise. We're going to assess every business and look for those multiple ways of winning, but not risk your money in investing in stocks that are overvalued. We're looking for businesses that are cheap, that have these multiple ways of winning, or on the short side, looking for expensive businesses that have, in our view, multiple ways that can lose. And this means that the portfolio is very, very different to what you would get if you're just investing in an index.
So collectively, if we're going to put our hands together and applaud the boys, it's great to see them.
Can you tell me a little bit about your position in Antipodes, please?
Yes, I've been at Antipodes since inception, which is now close to 2 years. My role at Antipodes is one of the deputy portfolio managers. And at Antipodes, we're a team of 12, and each of us is responsible for a global sector, and the sector that I take care of is consumer, global consumer.
So if I could just ask you to briefly explain what the Antipodes Global Fund invests in and how these investments are selected.
So Antipodes, by our name, by nature, we invest in global stocks abroad. The selection process is actually quite detailed when we get down to that stock level, but ultimately for every stock that we put up for the portfolio to be under consideration, we require there must be a margin of safety, which comes back to price. What price are we paying for this stock today?
Yeah.
It needs to be well below what we think it's worth in the future. That gives us that margin of safety. Another key tenet we must apply is that there must be multiple ways of winning. Many investors might come up with a good narrative to a stock or a business that we've all heard, or we've had that tip on the side, you've got to get involved in this stock for one reason. But that's not good enough for us. We need 3, 4, 5 reasons, or what we say, 3, 4, 5 multiple ways of winning on that stock. Otherwise, you might just come up with 2, which ultimately may just be 2 points of failure, and you lose money on the stock. Mm-hmm. And then the final point is, if you've done the work and you presented your case, the team needs to consider, does that go into the portfolio? We want to make sure that if you are putting up new ideas, it's not just a replication of an existing position or risk that already sits in the portfolio. We don't want to just multiply that factor. So we have to be quite conscious. Can it provide a diversified source of performance or alpha generation in that portfolio? And ultimately, we're trying to put all 3 together.
It sounds very complicated and comprehensive, not complicated necessarily, though I'm sure it is, but comprehensive analysis of stocks rather than just, as you say, listening to sentiment or whatever tip you've had on the day. Tell me, out of all the shares available to you, and if you can tell me how many you have got available to you, how many do you typically have in your portfolio at one time?
So on a global basis, our hunting ground is we're looking at businesses market capitalisation greater than 2 billion. That's what we're aiming for.
Right.
Of those stocks, there's about 4,000 or 5,000 available globally that are greater than 2 billion that we can look at. So that's the hunting ground. The funds themselves, typically we would have between 30 and 60 stocks across the 3 funds that we own, or 30 to 60 stocks in each of those funds. Mm-hmm. So it is quite a concentrated form of investing as well.
Sure. Of those 60 odd stocks, how much of a turnover do you have on an annual basis? How many times do you buy and sell?
Yeah, the easiest way that I can explain it is on a names basis. Mm-hmm. That turnover today is about 35%. Right. That's actually higher than where we'd want it to be. Ideally, we'd like it to be around 30%. But given the volatility that we've seen in markets over the last 18 months, that volatility has actually provided opportunities. So when markets have fallen sharply, that's given us a reason to go back into a stock or to actually buy more of our existing stocks. Conversely, as you saw after Trump or after the Brexit, stocks shot up. Some of those stocks that we own were beneficiaries of that and got to the levels where we thought, well, we can no longer justify having this in the portfolio anymore because the risk return is no longer there. So we sold out. So 35 is the short answer. Ideally, we'd like to be around 30%.
Sure. Okay. And you mentioned volatility, and you've also mentioned shorting. How do you take advantage of volatility in those in that discipline that you apply to buying or choosing stocks to buy. So what I'm saying is if you see the market's going down, how do you take advantage of that?
Generally, that's when because we know our stocks well, that's when we can top up those positions in those stocks. Or an example could be, say, when Brexit happened. We'd already been doing some work on Burberry, which is a well-known global luxury apparel stock or business. And that Brexit presented an opportunity that we could actually then step in and buy Burberry at the price level that we wanted to again meet those tenets that we had before: margin of safety, multiple ways of winning, diversified source of alpha in the portfolio.
Okay.
And that allowed us, we bought Burberry at the time, and so far we've done quite well out of that investment.
Okay. When people talk about global stocks, a lot of folk will just say, well, listen, I can get my exposure to global stocks by buying local, and that's BHP and Westfield and Orica and all these global Australian companies. How do you respond to that?
I'd say that's a very good point. You could also throw in there some great medical stocks here, like Cochlear, CSL, ResMed. They're all great locally grown businesses that have gone offshore and doing well overseas. So yeah, full credit to them. But I guess my concern with the statement is, yes, you get that, but at what price do you get that? Because you tend to find in Australia, the opportunities for local investors is pretty limited. Once you chop out banks and you chop out resource stocks, which is basically half of the ASX 200, what's that leave you with? A few stocks to choose from, only even less with exposure globally, which therefore means they're all chasing those great stocks and bidding up the price. Again, we look at it from a global relative perspective. We can get similarly great businesses, but lower risk or lower valuations overseas.
One stock in particular that comes to mind, a global stock, is Samsung, and that's had some bad press recently. You hold a fair amount of that. Can you tell me why that should be the case?
Yeah, I mean, Samsung has been one of those classic stocks that, you know, we all heard about it now. One of their latest phones had blown up, caught on fire. It was a public relations nightmare globally. They had to recall all the phones, and the Samsung brand got tarnished. We've owned Samsung for close to 18 months. It's been a core position within our portfolio. But we don't own it just for phones, because when you actually dig into the numbers, phones account for close to 15 or 20% of profits of the overall business. So there's another 80% that's not actually phone exposed. So if the market wanted to sell off for a phone reason, fine. We know there's actually a super strong memory business that accounts for 50% of profits, of which Samsung dominates as the lowest cost producer. There's only another 3 players out there in the world at a time when demand for memory is going up and up and up as we all use our devices more and more, and we upload and download more and more data. You need more and more memory to support that. Samsung is one of those key producers of the memory. So despite the distractions and noise, if the market wants to sell off for that reason, we're happy. We'll buy the stock cheaper, knowing there's more to that business and there's more value elsewhere in that business. And what are we now? 6 months down the track, Samsung's getting ready to release its next phone. Most of those disasters have actually been forgotten because Samsung, to its credit, bit of a slow start, but caught up in the end, managed it quite well with its customers. It didn't lose that customer loyalty because it offered refunds, swapped the phone, it offered cash. I think it also threw in some of those artificial intelligence new goggles.
It's the 3D goggles.
Yeah, they gave those out for free. So again, you can turn a disaster in actually a pretty good positive outcome. So they haven't lost those customers.
Yeah, thank you for that. Wouldn't it be easier just to invest in an index fund and get the same global exposure that way, and instead of paying extra fees to have a specialist look after your money?
Yeah, and that's been an ongoing trend now since the last global financial crisis, I think. I mean, that move of money now going into passive and ETF type funds to get that cheaper access to the global markets, yes, that's happening. But again, I would argue that it's been a bull market for the last 8 years. And at Antipodes, with those extra tools that we can provide to be able to manage currency and also to be able to provide shorts, we can get you similar exposure, but at a much lower risk, and offer protection along the way
That's
when
great.
markets will ultimately roll over at some point.
I hear what you're saying. That's great. I appreciate your time, Andrew, and thanks for coming all the way up from Sydney to do this for us.
No, it's been great. Thank you, John.